Welcome to Ring the Bell, brought to you by ASX and Bell Direct. My name is Jessica Amir and I'm with Bell Direct, and we're proudly with Andrew Campion, who's the General Manager of ASX listed products. Andrew, thanks for having us.
Thanks, Jess. Welcome back to the ASX.
So we're halfway through 2021 and it's a good time to reflect on where we're at and also look for new opportunities. So if we think about the Aussie share market as measured by the ASX 200, we're up 11.3% as at the time of recording this, and we're seeing economic activity linked stocks thrive. So Virgin Money is a standout, VUK. We've also got Codan, CDA, Pilbara Minerals, PLS, and REITs, REH. In terms of listed products on the ASX, we're also seeing a lot of momentum and money flows favour economic activity linked investments as well.
Thanks, Jess. Yeah, before we sort of start talking about markets, it's probably worthwhile just setting the scene in terms of what the macroeconomic outlook is on a global basis. And what we're seeing is that the outlook is quite positive. There's probably a couple of drivers behind that. Firstly, there's a lot of stimulus in the system, both fiscal and monetary. Governments seem to be continuing to stimulate the economy, and we're seeing in the US the Biden administration is looking to spend a lot of money on trying to update some of that US infrastructure. On the monetary side, central bankers don't seem to be in any rush to raise interest rates from what are historically ultra low levels, as well as some central banks are still using QE or quantitative easing to add to that stimulus level. And then the second factor at play is COVID-19, which sort of led us to this juncture in markets and the economy. So it seems like, at least in the developed world, COVID-19 seems to be in retreat. Vaccination rates are surprising to the upside in places that actually had a pretty tough 2020, like the UK and the US. Developing markets, developing economies like India and Brazil, very different stories. They're still doing it very tough through COVID-19. So that's the macroeconomic outlook. Turning to what that means for markets, well, it's still looking very positive for markets through 2021. And you mentioned sectors or stocks that are sensitive to the general level of economic activity, and that's very much at play. From a global perspective, a really interesting indicator there is Vanguard's Active Value ETF, VVLU is the ASX ticker. And that's had a great year. It's up almost 30%. Funds under management has quadrupled since the start of the year, from 50 million to 200 million. And it's driven by the active stock picking of Vanguard's team. And when you break it down to a sector level, what we're seeing in that particular ETF is big overweights in sectors like financials and energy, and a big underweight in technology, which obviously had a great run in 2020 but has pulled back a little bit in 2021. From a domestic perspective, there isn't a direct comparison to VVLU, but what we do have on the domestic focused ETFs is some sector ETFs. So VanEck's Bank ETF, MVB, I think is up about 25% this year. So what's driving that is a resumption of confidence in the banking sector. We're seeing bank earnings. There's a red hot property market at the moment, obviously. That's great, obviously, for bank earnings, and just as importantly, bank dividends as well. There were some shocks to the downside last year in bank dividends, but they're looking much stronger. CBA has regained its place as the #1 stock in the ASX 200, and it's hard to believe compared to a year ago, but it's now worth almost double its nearest competitor, Westpac, 180 billion versus about 95 billion, I think. Outside of, and obviously that's just all equity ETFs we've talked about so far. Outside of equity ETFs, it's a bit more of a mixed bag. Oil has obviously rebounded massively. It's hard to believe a year ago we were trying to get our heads around a negative oil price when briefly the Chicago oil futures traded at a negative price due to technical reasons there. Fixed income, obviously doing it tougher this year as interest rate, obviously there's an inverse relationship between bond yields and bond prices and bond ETF returns. The global benchmark of interest rates, the US 10-year Treasury yield has basically tripled from a year ago, got as low as 50 basis points, 0.5%. It's now at about 1.6%. So obviously that makes it tough to generate returns out of bond ETFs.
And you recently wrapped up the ASX Investor Day, going to 3 major capital cities, and it was also available online as well. So I guess for me, one of the takeaways was a couple of things, that you're seeing investors increasingly interested in green and lithium investments, also actively managed funds, which are available on the ASX under active ETFs. What were the key highlights for you?
It's hard to pick, Jess. I mean, it's one of the highlights of our year is the Investor Day roadshows. But I guess if I had to pick, those probably three presentations I thought gave great insights to the investors that were present. The first was by Firetrail. Firetrail is a boutique fund manager that has a couple of funds on the M Fund service. And they did a great presentation around the fundamentals of company valuation and company investing. So they used Qantas as a case study there, which I think is a great way. Obviously, Qantas has had a very turbulent ride, if you pardon the pun, over the last 18 months with COVID and all that. So they focus on a few things about how to value a company. Firstly, every company has a price. The valuation, obviously, is what drives it. And over the long run, a stock like Qantas might have a long run or average PE as one valuation metric, but that can really vary over time just as the market sentiment changes. So, for example, Qantas has had a long run PE of around about 9 times earnings, but it's been as low as 4 during COVID last year, as high as 14. So you need to keep in mind that the market perception of a particular stock relative to its earnings can change over time. And they also said it's very key to focus on what matters, or if there's an electrical engineer, they'd say focus on the signal, not the noise. So there's a lot of noise around a stock like Qantas, the fleet being grounded, oil prices, that sort of stuff. But you need to focus on things like the strength of the balance sheet and the strength of the domestic business and the frequent flyer business, and try and look beyond that noise of the fact that the international flights aren't running anywhere near capacity at the moment. And also taking a longer view. You should never invest in a company for a short-term profit. Investors like Firetrail are always taking a 5, 10-year or longer view. So that was the first presentation that stood out for me. Secondly, ETF securities, also a great presentation around the theme of megatrends, or where the world is going and how do we invest in that. So they looked at various megatrends. One of them was like just the technology transformation that's happening, and some sub sort of themes to that broader megatrend. So the Internet of Things, having your toaster and your coffee pot being connected to the internet, software as a service, cloud computing, big data, 5G, as we all upgrade our phones from 4G to 5G, and just the potential to invest through ETFs in those trends. So ETF securities has a range of ETFs, FANG, Robo, ACDC, tech, investing in those sort of things like lithium you mentioned already, electric vehicles, robotics. So there's a great range of thematic ETFs out there, and ETF securities is one of the leading issuers of those sort of thematic ETFs. And then lastly, I think iShares did more of a back to basics, a checklist approach to how to go about picking ETFs. Not all ETFs are the same. You really need to look under the bonnet, look at things like who the manager is, can they track that index really, really closely? What's the underlying index methodology? Is it really going to give you the exposures, the sectors and the stocks that you think you're getting, the liquidity, and also just the total cost of ownership? It's not just about the MER, the headline management cost. You want to look at the total cost of ownership, so tax considerations, bid-offer spreads when you're trading in and out of these products. So I think across those three presentations, there's some great insight for investors.
Well, you've given viewers and listeners a lot to consider, very comprehensive. Andrew, new financial year around the corner, what are the biggest investment opportunities that really stand out?
Well, Jess, I'm sure when you were a kid, your parents told you to eat your greens, eat your vegetables, and unfortunately I'm going to do a little bit of that now. Rather than trying to give you a hot stock or a hot sector to look at, I think it's really time for investors to eat their greens. Markets have had a huge bounce in the last 12 months. A lot of people that were probably very nervous about their outlook for their portfolio, particularly if they were using it for income, are in a lot better position now. So now's not the time to be complacent. Now's the time to reassess your portfolio. Make sure you've got the right level of diversification. Make sure you've got some shock absorbers in your portfolio if there is a pullback. There's a lot of good news priced in, and as we know, markets can stop focusing on the positive and focus on the negative in a very quick period of time. So, like I said, make sure you have defensive allocations, either defensive stocks or other sources of defensive asset classes, like fixed income, for example. If there is another shock, if COVID worsens again, it's very likely that interest rates will go back down again. So those fixed income products should perform well, providing that shock absorber to your portfolio. So it's very much time now to sort of consider those elements while the market's quiet, benign, ticking slowly upwards, rather than waiting until volatility potentially picks up again.
Wonderful. Andrew Campion, General Manager of ASX listed products, thank you so much.
Thanks, Jess.